Have you ever stared at your banking app on a stressful Tuesday morning and wondered what those little digital numbers actually represent? You work 40 hours a week, sweat through endless meetings, and skip the nice coffee just to make those digits crawl upward. But if you walk into your local branch tomorrow and demand to see your actual physical pile of cash, the teller will look at you with deep suspicion. That is because your money does not exist in a heavy metal vault protected by laser beams and guards. It is just a tiny collection of data sitting on a humming server in a random warehouse. We trade our limited time on Earth for green paper rectangles and digital pixels, and we do it because we all agree to believe in the same massive magic trick. This giant magic trick keeps our cities running, our shelves stocked, and our businesses open, but it only works if we never stop to look too closely at the illusion. If we all decided tomorrow morning that these numbers were completely worthless, the entire global financial system would vanish into thin air. So let us take a step back and figure out how we ended up playing this bizarre game of collective pretend. Before we could swipe pieces of plastic or tap our phones against a terminal, we had to trade actual physical items. Imagine you are an ancient farmer who spent months growing delicious apples, but you desperately need a new pair of leather boots. You walk over to the local shoemaker, but it turns out he absolutely hates apples and already has 50 baskets of them rotting in his backyard. You are stuck with a pile of fruit that will spoil in a week, and he is stuck with boots he cannot wear all at once. To solve this incredibly frustrating mismatch, humans had to invent a middleman asset that everyone in the community would always agree to accept. Over the centuries, people used all sorts of strange items as this middleman, ranging from shiny seashells and salt blocks to giant limestone rocks. On the remote island of Yap, people used massive stone discs called rye stones that were so heavy they could not even be moved. When one family lost their giant stone in the middle of a deep ocean storm, everyone agreed the stone was still there on the sea floor, so the family could still spend it. This historical oddity proves that money has never been about the physical object you hold in your hand. It has always been a mental ledger of who owes what to whom. Eventually, we settled on precious metals like gold and silver because they were rare, hard to fake, and did not melt when left out in the rain. Carrying heavy bags of gold coins was incredibly annoying, and it also made you an easy target for highway robbers. To keep their wealth safe, wealthy merchants started depositing their heavy gold into secure vaults owned by local goldsmiths. The goldsmiths would lock the metal away and write out a simple paper receipt showing exactly how much gold belonged to that merchant. Soon, merchants realized they didn't need to go back to the vault every time they wanted to buy a cart of wheat. They could simply hand the paper receipt to the wheat seller, who would gladly accept it because he knew he could go to the vault and claim the gold himself. This was the birth of paper banknotes, and it changed the world of business forever. These receipts were incredibly convenient because they were light, easy to fold, and could fit right inside your pocket. But this convenience came with a massive trap that would change the course of human history. The goldsmiths quickly noticed that most people never actually came back to withdraw their physical gold. The metal just sat there collecting dust, while the paper receipts did all the hard work in the marketplace. This gave the vault owners a highly tempting idea that would lay the foundation for modern banking. For generations, the paper money in your pocket remained a direct promise for a specific amount of precious metal. But as populations grew and economies expanded, governments realized they could not print enough paper receipts because they could not find enough new gold in the ground. This conflict reached its breaking point on a Sunday evening in 1971 when President Richard Nixon announced that the United States was cutting ties with gold once and for all. This event completely decoupled the American dollar from any physical anchor, turning it into what we now call fiat money. Fiat money is simply currency that has value purely because a government declares it has value and citizens agree to use it. Without gold backing the currency, the government could print as many dollars as they deemed necessary to keep the economy moving. This was an incredibly powerful economic tool, but it also opened the floodgates for steady, continuous inflation. When the supply of dollars increases faster than the actual goods we want to buy, each individual dollar buys less than it did before. That is why your grandfather could buy a brand new car for $3,000, while that same amount of money barely covers a decent used mountain bike today. While the central bank manages the overall money system, the vast majority of our money is actually created by regular neighborhood banks when they write loans. Imagine you decide to buy a house and need a $300,000 mortgage to make it happen. You walk into a bank, sign a massive pile of confusing paperwork, and walk out with the loan approved. The bank does not take $300,000 out of other people's savings accounts to hand to you. They simply open up their computer database, look at your name, and type in 300,000 new dollars. By typing those numbers, the bank has literally conjured new money into existence out of thin air. This works because of fractional reserve banking, a design where banks only keep a tiny percentage of their total customer deposits as physical cash and lend out all the rest. This means that our entire modern financial system is built on a mountain of digital promises and consumer debt. If every single person in the country paid off all their loans and credit cards tomorrow morning, the money supply would almost completely collapse. This is why banks are so desperate to keep lending you money for cars, college degrees, and home renovations. Because our money is constructed out of collective belief and digital records, the entire structure depends on a single, highly delicate ingredient called trust.
If a community suddenly stops believing that their currency has value, the entire economic illusion falls apart almost instantly. We have watched this tragic story play out in nations like Zimbabwe and Venezuela, where governments printed excessive amounts of money to cover their rising debts. Prices rose so fast that people had to bring wheelbarrows of cash to the supermarket just to purchase a single carton of eggs. This extreme scenario is called hyperinflation, and it shows what happens when people lose all faith in their paper money and start bartering with actual goods instead. Another terrifying consequence of a trust-based currency is a classic bank run, which happens when depositors panic and rush to withdraw their cash at the exact same moment. Since banks keep almost none of your money in physical vaults, they cannot satisfy all these requests at once, leading to an immediate collapse of the institution. To prevent this, governments develop deposit insurance up to $250,000 to keep the public calm. They understand that keeping you from panicking is the only way to protect the shared magic spell of modern finance. Once you understand that money is a social construct, you can stop treating it like a sacred treasure and start treating it like a useful tool. Keeping your life savings in a big pile of physical bills is actually a guaranteed way to lose your wealth to the silent erosion of inflation. To truly survive this chaotic system, you have to exchange your digital currency for tangible assets that exist in the physical world. This is the main reason why people spend their money to buy houses, invest in productive companies, or build valuable skills that others will always pay for. Money is simply an incredibly efficient technology we invented to help us work together, design skyscrapers, and trade across continents without carrying actual goods around. It is a massive game of financial pretend, but as long as we all play by the same rules, the machine keeps spinning. Just keep in mind that while the numbers on your phone screen might be a digital fiction, your time, your hard work, and your health are entirely real. Do not lose sight of the actual experiences and security that your money is supposed to buy in the first place. This video is intended purely for educational purposes, so be sure to consult with a financial planner before making any big decisions with your actual money.